So if you're an investor and you're looking at your screen right now and you're focused on Alibaba, ticker BABIA, you might be feeling that pit in your stomach.
Yeah, that icy grip of fear. It's a real thing.
Absolutely. We saw it pull back pretty hard, dipping below that $151 mark. And all the noise you hear online, it just screams that the rally is over, maybe even that something worse is coming.
And that collective fear, that herd mentality, that is exactly what we need to dig into today, because our analysis points to something completely different.
Okay.
This isn't a crash. This looks like a classic, almost textbook bear trap.
A bear trap.
Yeah, a calculated move. It's designed to shake out retail investors, people like you listening, right before what our Sources project could be a massive leg up.
All right, let me unpack that immediately, because the tension here is, it's real. You've got this shaky looking chart on one hand, but then underneath it all, you have this powerhouse company. It's trading at a PE of barely 20. It's sitting on billions in cash, and it's right on top of a major support zone.
And that's the warning we have to get across in this deep dive. If you panic sell now, you are essentially you're handing your shares over to huge institutional players at a discount.
They're waiting for that fear.
They depend on it. That's how they accumulate shares on the cheap.
So our mission today is to figure this out. Is this fear justified, or is this really a gift-wrapped opportunity? We've got a pretty clear plan. First, we'll look at the technicals, the evidence for this so-called bear trap.
Then we'll get into the fundamental safety net. The financial cushion that makes betting against BABA so risky.
And finally, it will hit the big catalysts, the stuff that could really ignite the next big move. So let's start right there with the chart itself, the source of all this anxiety.
Okay, so let's define what a bear trap actually is, because the mechanism is key. It's a false signal. It's a price move that's sort of engineered to look like the stock is about to completely collapse.
And that tricks people into selling.
Exactly. It triggers stop losses. It gets people to short the stock, and then boom, the price just violently reverses course.
And all the people who bet against it, the bears,
they're trapped. They have to buy back in to cover their positions, and that buying just fuels this massive surge higher.
So what about BABA's recent move makes it look so textbook?
It's the detail of the low point. It's not just that it fell, it's how it fell. The price dropped to an intraday low of $148.52, that exact number.
$148.52. Why is that so specific?
That's where the trap sprung. If you look at the chart, the candlestick, you see this long tail at the bottom. Traders call it a wick.
Right.
And that wick tells a story. It means the price was only allowed to be at that low level for like a split second. Aggressive buying pressure, we're talking institutional money, just swooped in and swallowed up all the panic selling instantly.
So the stock is basically sitting on this major support block, right? The 148 to 150 zone.
Yes. And the whole narrative the bears want you to believe is that this floor is finally breaking, that it's all over.
But if you zoom out...
it's just healthy consolidation. Remember, this stock ran all the way up to almost $192. A pullback after a run like that is completely normal. It's necessary.
The trap is designed to make you forget the big picture and just focus on the scary red candle for today.
Precisely.
So let's talk about the mechanism for a regular investor. I have my stop loss set at, say, 149. This dip hits 148.52.
And your system automatically sells for you. You're out. You're forced to sell right at the bottom, convinced it's going lower.
And as soon as my shares and thousands of others are sold,
the institutional buyers have what they want. They've loaded up at a great price. The selling pressure is gone, and the price snaps right back up, leaving you holding cash, having sold at the absolute low.
So now that the price is sort of stabilizing around 150, what's the takeaway?
The takeaway is that the risk to reward is just incredibly skewed to the upside right now. If that floor at 148 holds, and that big wick suggests it will, you're positioned for a really powerful bounce.
And the risk is very defined.
Very defined. The downside is right there. It's not some unknown abyss.
Yeah.
You have massive potential upside versus a very clear, limited downside.
Okay, that technical breakdown makes a ton of sense. But, charts can lie. Technical strength needs fundamental backing. So let's move on to that. Why is it a bad idea to bet against this company's actual business right now?
Right. This is where we get away from the squiggly lines on the screen and look at the balance sheet. And betting against BABA is dangerous because the company is, for lack of a better term, a cash fortress.
A cash fortress. I like that. What are we talking about in terms of actual numbers?
We are talking about tens of billions of dollars. This results in a massive positive net cash position. It means they can handle almost any economic storm, any geopolitical issue without breaking a sweat. It gives them safety and, more importantly, flexibility.
So that cash provides a sort of intrinsic value floor. Even if the stock price drops, the actual value of the company's assets puts a limit on how far it can really fall.
Exactly. And that strength is what makes the valuation argument so compelling. You look at similar U.S. tech stocks, the big names in cloud and AI.
Yeah, they're trading at insane multiples, 30, 40, even 50 times earnings.
Right. And all that future growth is already priced in. But BAVA, it's trading at a PE of around 20, just over 20.
So what you're saying is you get all that exposure to e-commerce, cloud, AI in the world's second biggest economy, but you're paying a value stock price for it.
Yes. Think about what that means. Just for the valuation multiple to catch up to its peers, not even exceed them, just to catch up to a conservative 30 times multiple.
That's a 50% increase in the stock price right there.
Just from a re-rating. It's a huge potential catalyst.
Okay, I have to play devil's advocate here because I know what everyone listening is thinking. PE of 20 is great, but it's a China stock. What about the regulatory risk, government interference, all that stuff?
That's the essential question. And the answer is that risk is why the PE is 20. The market has already priced that in. That's the discount.
So the argument is that the fear is already baked into the price.
It is. But people forget this isn't some speculative startup. This is a profit machine. Our sources highlight it clearly. $17.2 billion in net income. That's trailing 12 months.
Can you just quickly define TTM for us?
Sure. Trailing 12 months just means the last 4 quarters of earnings added together. It gives you the most up-to-date picture of their profitability. And $17 billion is not speculative. It shows you're investing in a real cash-generating business that is just being undervalued because of those geopolitical fears.
So the fundamentals provide a cushion against those very risks.
That's the safety net.
Okay, so we've got a chart that's primed for a rebound and fundamentals that prevent a total collapse. But we need a push. We need momentum. So let's get to the catalysts. What's going to actually drive this thing out of the 150 zone for good?
Well, the single biggest driver, I think, is their position in cloud and AI. As AI demand explodes everywhere, Alibaba's Cloud Intelligence Group is the undisputed leader in the Chinese market.
And the Chinese government is pushing really hard for domestic tech independence. So Alibaba Cloud is basically critical infrastructure at this point.
It is. And the data shows that division is getting more and more profitable. That's huge because cloud offers higher margins, and it could be the engine that gets Wall Street to re-rate the entire company.
And it's not just about China anymore, is it? They're expanding.
Absolutely. The international digital commerce arm is growing fast. That the diversification is so important. It protects them from being purely dependent on the Chinese economy or, the whims of Beijing.
So they're building revenue streams outside of China that the market might value more highly.
Exactly right.
So when you put it all together, the fundamentals, the catalysts, what's the consensus on Wall Street? Are analysts seeing the same cheap valuation?
Overwhelmingly, yes. This is the third-party validation. The average analyst price target on BABA right now is $180.
Okay, so from 150, that's a solid 20% upside right there, just to meet the average.
Right. But it gets more interesting when you look at the high end of those targets.
And where are the biggest bulls putting their money?
The highest price targets we're seeing in the analysis go up to $230 a share.
Wow. Okay, so if you're buying in around 150, you're looking at a potential 50% return if those more bullish scenarios play out.
That's the power of buying a deeply profitable company at a suppressed valuation. All of this makes that recent pullback look less like a warning sign and more like a carefully planned opportunity for big money to load up.
Right. They know exactly where the retail stop losses are clustered and can use that to their advantage.
It's a strategic accumulation. That's what a bear trap is.
Okay, let's put a bow on this. Let's synthesize everything and give a final verdict. This has been a really compelling deep dive. The conclusion seems pretty clear.
I think so. The evidence strongly suggests this drop isn't a crash. It feels like a gift. A strategically engineered gift for buyers who are paying attention.
You've got the technicals on the 150 support level, you have the cheap valuation, and you have the fortress balance sheet.
It checks all the boxes for a classic bear trap setup. The evidence is just too strong to ignore.
So for our listener, what's the actionable insight here? What's the key zone to watch?
Based on the analysis, that 150 level is the critical zone. The aggressive buying we saw at 148.52 identifies this as the prime buy the dip area. The expectation would be to watch for a bounce back towards 160 in the next few weeks.
And this really highlights the big difference in mindset, doesn't it? You have the retail crowd, the herd who are panicking based on a scary-looking chart.
And then you have the smart money, patiently accumulating shares of a great company that they know is on sale.
Which brings us to our final provocative thought for you to take away from this. Think about the concept of this bear trap. And consider the huge difference between trading based on chart fear, that instant gut reaction, and investing based on verifiable facts, like a PE of 20 or billions in cash.
The ultimate question for you to ask yourself is this. In your own strategy, how much weight are you giving to short-term noise versus long-term value? Are you the one being trapped, or are you the one setting the trap?